We live in interesting times, don't we? We have woken up April the 5th, Saturday morning, and we've woken up to Wall Street having another 5-6% collapse. Dow Jones down 2,231 points. The S&P 500 down 5.97%. The Nasdaq down 5.82%. That takes it down over 20% now, 22.85%. And that's the official definition of a bear market. Although if you talk to a broker, a bear market is not a drop of 20%. A bear market is measured by longevity rather than magnitude. It's when the market stays down and everyone loses interest over a period of months, if not years. So down 22.85% on the Nasdaq from the top. Our market is currently down 11% from the top, and the futures this morning are down 331 points, which is implying a 4.29% drop on Monday morning. And what's caused this, of course, is the Chinese have decided to retaliate. At 9 o'clock last night, they announced they're going to impose a 34% tariff on all US goods into China. And I think that will embolden other countries, let the trade wars begin. The title on the newsletter this morning is Trump Tees Off Whilst Wall Street Burns. And this is likening, as Henry did last week, this is likening Trump to Nero, who fiddled whilst Rome burns. And Trump has been shouting at journalists from golf carts about how the stock market is going to be great again and America is going to be great again. I think he is fast burning credibility when trillions of dollars are disappearing in the stock markets behind him. The other thing that's hurting Trump, I think, is how do I put this? The world is confounded by the naive and almost childish way that the tariff formula has been calculated, and that's exposed Trump to, and I think Alan Kohler on the ABC News put it really well last night. He said, we are in the hands, he was talking about Trump invoking emergency powers and taking control of this tariff policy, which so it doesn't have to go through Congress. And as Kohler said last night, I think good journalism is when you can express what everyone knows to be true but can't express themselves. He said, we are in the hands of one man who doesn't know what he's doing. And I think that is striking home to the whole world at the moment. And unless there is some wind back of tariffs and a capitulation from Trump, which I don't think his personality will allow, that he's made a mistake, then things are going to look grim. And we have brokers this morning predicting a 60% chance of a recession now this year in the US. Everyone seems to be more obsessed with the recession problem than the inflation problem this is likely to kick off. And overnight as well, Powell has spoken and made it quite clear that the Fed are not about to come to the rescue. There has been talk about whether there was a Fed put in place. In other words, the Fed would rescue everything. I think the Fed probably busting out the champagne in their boardroom at the moment at the demise of Trump and the revealing of Trump as a naive politician with dangerously pulling levers on the economy that he doesn't understand. So the good news is, there is some good news, is that bond yields are dropping quite hard. And we have seen in the last week, we've seen a 20 basis point drop in the US 30-year bond yield and mortgage rate. On the back of that, interestingly, last night, despite 5-6% drop in the US market, D.R. Horton, one of their biggest house builders, was up 4.5%. Lennar, another one, up 2.4%. NVR up 4.2%, all housing related stocks. So maybe my daughter will be able to buy a house this year without having to pay current mortgage rates. The markets today, as you know, the markets today members are hopefully in cash. The markets today strategy portfolio is in cash, both the real fund, which we call the managed strategy portfolio, and the newsletter, which is hypothetical, and the newsletter strategy portfolio. The newsletter, you can rest assured, the newsletter portfolio represents the real portfolio as well. So we're sitting in 100% cash. So, and we're in the growth portfolio, we're in 83% cash, which is, and the only stocks we're holding are 2 gold stocks. We have to view this, having timed the top. You can time the market. I hope everyone's beginning to realize that now. Having timed the top, the game now is clearly to time the bottom. And as we found out, as everyone will have found out from the 87 crash onwards, the tech wreck, the GFC, the pandemic, we are setting up for a fantastic buying opportunity. You can only take advantage of it, of course, if you have cash. So that's why you cash up, not because you're worried about losing money, but because you want to be have the ammunition when the bottom comes. So our game is to time the bottom. That's our one mission at the moment, is time the bottom. How do you do that? Well, we're obsessed about recession at the moment, and that is the anatomy of every pivot point in the market's different. This one is related to tariffs causing a recession. So the market's going to bottom when recession fears peak, and we don't know when that is at the moment. What are the signs that recession fear is peaking? Well, recession is going to kick off a drop in the US dollar, a drop in bond yields, a drop in equity markets, and all the indicators, be that everyone talks about the VIX volatility index, although it's not really a forward-looking index. It's just tells you what's happening today. But it does show exaggerated movements on a chart, which is useful. And that has shot up overnight. You'll see up to 40 during the pandemic and GFC. We were looking at 50. So we're getting up there. We're having a spike. So when some of the indicators, which are not the ingredients, but the indicators like the VIX volatility come off, that's a sign to start waking up a little bit. And I think you will see, what you will see at the bottom is a sharp 1 or 2 day rally in the equity market. And that will be accompanied by a bottoming in bond yields, because as recession fears disappear, suddenly rates are going to be able to go higher. So a bottoming in bond yields, a bottoming as well in the US dollar. The US dollar represents the US economy. So we're looking for a bottoming in the US dollar and a bottoming in equity markets, which usually happens, trends start fast. So the new uptrend will start fast. So we'll probably miss 2 days of a 8% rally or something, and that'll be the sign that the longer term trend is going to change. So for now, there's really not much to do. You can think about trying to make money. There are 4 obvious ASX listed ETFs that you can buy, which make money out of a market going down: BBUS, BBOS, Bear, and SNAS. But in the strategy portfolio, we're not in the game of trying to acutely make money trading. We're really now looking for the next uptrend, and that is going to take more rather than trade short term. So waiting for the bottom. If you're trying to pick when the bottom is, you need to no more than read the newsletter. You don't need to try and divine it yourself. We will be all over it. That's the great thing about us, is that we love what we do, are hyper vigilant, and will be at some point reacting to the market's bottoming, not predicting anything, reacting to the way that the market's bottom. And I would say to you that after this sort of smack to the head, you just ignore all those US media guys saying, oh, this PE is this, and this is value, and rubbish like this. Sentiment's taken a massive hit in the last 2 days in the US. We don't come out of this quickly. we're going to be groggy for a while, so there's no rush. The thing to do now is to sit back and wait and work on your golf handicap, which is what I will be doing today. Don't be tempted to buy the market just yet. I hope you're in cash. Just keep tuned in for the bottom.